Imagine waking up on a Tuesday morning, making yourself a coffee, and knowing that while you slept, your money earned you another paycheck. That is the ultimate dream of financial freedom, and living off dividends in Australia is one of the most achievable ways to make it happen. The secret weapon for Aussie investors is something almost unique to our tax system: franking credits. When an Australian company pays you a dividend, they have usually already paid a 30% corporate tax rate on those profits. The government passes that tax back to you as a credit. So when you see a 4% headline dividend yield on the ASX, the real grossed-up yield is often closer to 5.5 or 6%. This prevents your investment returns from being taxed twice, giving Australian dividend portfolios a massive after-tax advantage over international ones. To figure out how much you actually need invested, we first have to determine your target annual income. According to the Association of Superannuation Funds of Australia, a single person needs around $54,000 a year for a comfortable retirement, while a couple needs roughly $77,000. This covers comfortable living expenses like private health insurance, running a vehicle, domestic holidays, and dining out. If you prefer a more luxurious lifestyle with international travel, you're looking at $100,000 or more annually. Assuming a sensible and realistic grossed-up yield of 5.5% from a diversified Australian portfolio, we can run the math. If your goal is a modest or lean $50,000 a year, you need about $910,000 invested. To achieve a comfortable lifestyle at $75,000 a year, your target portfolio size is roughly $1.36 million. If you are chasing a full-fat lifestyle of $100,000 a year, you'll need approximately $1.82 million invested. Reaching these numbers does not require a massive inheritance or an extreme income. It requires consistency. If you invest $1,500 a month into a diversified portfolio, averaging an 8% total return, you'll cross the $900,000 mark in about 19 years. Bump that contribution to $2,000 a month, and you can compress that timeline to around 17 years. When building this wealth, the biggest trap to avoid is chasing unsustainably high yields. A stock advertising a 12% dividend is almost always a value trap, where the stock price has collapsed or a dividend cut is imminent. Instead, the foundation of a reliable income stream rests on boring, stable blue-chip companies or broad market dividend ETFs. Exchange-traded funds like VAS or VHY allow you to instantly diversify across dozens or hundreds of companies with a single trade. During your wealth-building years, turning on a dividend reinvestment plan will automatically use your payouts to buy more shares, accelerating your compounding snowball. By remaining consistent, utilizing broad ETFs, and letting franking credits shield your income, financial freedom through dividends is entirely within your reach.